our analysts, they and portfolio managers, they look for the winners over the long term, right? The next 5-10 years. The way I look at it, and I've studied this extensively, I've looked at the Nifty 50 phenomenon, which started back in the early 70s. So back then, if you may remember, I wasn't quite around there then yet, but after the 68 speculative glamour stock bubble, the market fell 36%. It wiped out retail, and the market was in the hands of institutional investors, and everyone got so burned by the glamour stocks, they just wanted to buy tried and true earnings growers, IBM, Xerox, et cetera, Colgate. And those stocks delivered, but they ended up trading at really an extreme. They ended up trading at twice the market's valuation. So there was a 2x premium. And then, inflation happened. It wiped out valuations everywhere. And they went from 20x to 7x by the late 70s. And then in the late 90s, we had the same thing. Different companies, of course, different players, but that was the dot-com bubble. Again, a 2x valuation premium. The market stayed at 20x, and those Nifty 50 went from 20 to 40x. That bubble imploded on itself. Now we have, again, dominance by, Mag 7, Nifty. I tend to kind of still look at it as Nifty 50, even though there are fewer than 50, but just to be consistent, the premium on the valuation side is only about 30%. It's not the 100% that it was the last two times. So these stocks have now dominated for almost a decade, but it's been mostly justified by earnings. And that's a different take on it.
So, I mean, the way I kind of phrase it is just tech has led this market for such a long time, and I kind of feel conditioned that if tech's not going to lead this market's not going higher. I'm not sure if that's the case, but do you still feel like tech and some of these things have to work for this market to work?
So it's a nuance of overall participation in the market versus who is outperforming, right? So last year we had the record narrowest market. Only 26% of the stocks in the S&P outperformed the S&P. So that's the lowest we've ever seen, and on par with early 70s, late 90s. So the market does eventually broaden. I mean, that's just the mean reversion nature of the market. And I am in the bullish broadening camp for this year. I mean, when you look at, obviously, S&P 5, cap weighted is making new highs. It's at 5,000. But I look at SPW, S&P 500 equal weighted index. To me, that's the most important chart. And that's been sitting below its all-time highs now for like 107 weeks. Wow. But it's like 2% below, right? Yep. It's on the cusp. And I do think that history will tell you, right, market goes up 70% of the time by about 10, 11%. It's the market's inherent nature to go up. So, you want to be a bear with some caution because you're really fighting the odds. So to me, it's a question of the generals are leading the soldiers. Obviously, the market made a new all-time high in January. January was an up month. So these things are momentum builders. So in my sense, the SPW will follow suit. The market will broaden. But that doesn't mean that other stuff will outperform the mega cap growers, right? That doesn't mean the banks are going to outperform. So I don't have a good handle on who's outperforming, but I do have a sense that the market's going to broaden out. And for an investor who might have missed out the rally last year, that's kind of a second chance to still participate.
You guys did sector funds. It was like revolutionary. Select funds. It was revolutionary. Yep. People thought you were nuts. Oh, this can't do this. It breaks prudent man rule. People over at Putnam, their heads are spinning. They can't do that. And now it's one big sector ETF. Jurrien Timmer on how we're handling passive and active ETFs. Forget about Bitcoin and all that. Just for mere mortals like me, we've become one big select fund, haven't we?
It depends. I mean, there's a fund for everyone, right? I mean, there's many of them, and now even in digital assets there are options, and I'm very proud of our team and how well we've done in terms of launching.
You think BitDog's a legit asset?
But but it's a question of portfolio allocation and having blunt instruments versus surgical tools, and it's good to have the options. And they're not for everyone. I mean, for many investors, it's fine just to buy some S&P or some MSCI EFA or World ex-US. But others want to get more specific, and so we can go value, growth, small, large, US, non-US, developed, emerging, and there are areas where you want to be nuanced, like in emerging markets. They're not all created equally, and so you want to be discerning there.